In the coming weeks, the financial system is set to move trillions of dollars into some of the biggest initial public offerings in history, and your retirement account is being positioned to fund the entire transaction. Three tech giants are preparing to list on the open market: SpaceX, OpenAI, and Anthropic. Their combined valuation is projected at roughly $4 trillion. SpaceX alone is aiming for a $1.75 trillion valuation, making it more valuable on day one than every American defense contractor combined. It would be bigger than Saudi Aramco was in 2019, despite the fact that SpaceX lost $5 billion last year. This use of retirement capital is part of an institutional shift. Larry Fink, the head of BlackRock, has stated that pension and savings accounts will be instrumental in building out this new AI infrastructure. Because the majority of modern savings are parked in passive index funds, your 401k essentially operates on autopilot. When these companies enter the major indexes, the system is designed to buy them automatically. Historically, highly unprofitable companies like SpaceX were barred from automatic inclusion in passive funds. The rules required a proven track record and a minimum level of public ownership to protect everyday investors. However, on May 1st, major index providers like the Nasdaq quietly revised their inclusion criteria just as these massive IPOs approached. A new fast entry rule was introduced. It strips away the traditional waiting period for new companies, cutting the time to enter an index from up to a year down to just 15 trading days. These procedural changes prioritize speed over traditional vetting. By shortening the inclusion window, the system ensures your capital flows into these newly public firms almost immediately after they list. The math of these rule changes is specifically calibrated for firms with a small float, the percentage of shares available for the public to trade. While the Nasdaq previously required a 10% minimum, it recently removed that barrier to accommodate firms like SpaceX, which plans to list with a float of only 4%. For stocks with these small floats, the index now applies a legal multiplier. A 4% float is mathematically treated as if it were 12%, forcing index funds to buy 3 times more stock than the actual available supply would dictate. These rules provide a solution for early insiders and venture capitalists who are currently holding trillions in paper wealth. To turn those massive paper gains into actual cash, they need a buyer large enough to absorb their shares. At a $4 trillion valuation, few active investors have the capital to participate. The only entity with enough scale to provide that exit liquidity is the collective pool of American retirement accounts. The system has been recalibrated to ensure that your passive contributions provide the guaranteed demand tech billionaires need to offload their positions. The rush to go public right now suggests that the current tech boom may be resting on a fragile accounting foundation. This cycle is funded by debt. Big tech companies issue billions in corporate bonds to invest in AI startups. Those startups then immediately spend that cash renting computing power back from the same big tech companies, who record the transaction as revenue. The data shows how dependent these giants have become on this loop. Spending commitments from OpenAI and Anthropic now represent roughly half of the total revenue backlogs for Microsoft and Amazon. Despite high revenue numbers, the cost of building this infrastructure is immense. When you account for capital expenditure, the actual free cash flow of these tech leaders is collapsing towards zero. This debt-fueled growth is facing a macroeconomic wall. Rising treasury yields and shifts at the Federal Reserve mean the era of cheap capital is ending, making it much more expensive to keep this circular economy spinning. To validate their valuations before borrowing costs spike, these companies must transition their paper wealth onto the public market as quickly as possible. We may be witnessing an earnings bubble. While stock prices look reasonable on paper, the underlying corporate profits are being artificially propped up by circular spending and debt. This mirrors the lead-up to the 2008 financial crisis. At that time, banks and home builders showed strong earnings, right up until the moment their underlying assets were exposed as being worth a fraction of their book value. Today's market is showing a historical anomaly called negative breadth.
The S&P 500 is hitting record highs, yet more individual stocks are currently falling than rising. The entire index is being carried by an increasingly narrow group. Currently, just 41 AI-related stocks account for nearly half of the entire S&P 500's total market value. Passive index funds have become dangerously concentrated. These accounts now function as a singular, heavy bet on the AI sector, lacking the broad economic diversification they were originally designed to provide. History suggests that a technology can change the world while still being a disastrous investment for the first wave of buyers. During the railroad boom of the 1800s, the tracks successfully connected the continent, but almost every original investor was wiped out in bankruptcies. We saw it again with the fiber optic boom of the 1990s. The companies that spent hundreds of billions laying the cables for today's internet went bankrupt when the dot-com bubble burst. In every instance, the infrastructure remained. A second group of investors eventually bought those assets for pennies on the dollar and built the next era of commerce on top of them. Artificial intelligence is a genuine technological revolution, but under these newly rewritten financial rules, your retirement account has been engineered to absorb the costs of the initial bubble, allowing the technology to move forward while the first generation of investors bears the loss.